We got huge economic data last week. The Federal Reserve is meeting Wednesday of this week, and they're going to decide interest rates and kind of give us an idea what they think is probably going to happen throughout the next several months for interest rates, given the data we just looked at. So how does one get ahead of the curve and understand the economic data and how that will apply to the stock market? Let me break down some of the key indicators from last week and how the Federal Reserve may be looking at that this week and moving forward throughout the next few months. Let's jump into the computer. I'll show you what I'm looking at. If you're just joining me for the first time, thanks so much. First and foremost, I'm an economist and I break down the economy and to see what's driving the economy and try to figure out how to get ahead of the curve on economic indicators. Secondly, I'm a value investor and I break down stocks as value investments. Some value investments are far better than others. Some are overvalued, some are undervalued. You can pretty much look at every single stock from the perspective of value. But what we're looking at here, so I take the S&P 500, I have all 500 shares inside that, and I asked the question, what does the next 4 quarters look like for earnings per share projected, based on an average from all of the analysts that are expecting what they are for each respective company. Inside this, I only have one share because I care more so about the individual shares versus the weighting in the S&P 500. Certainly some companies are bigger than others, but when you jump into the S&P 500 by and large, all those companies are fairly large. And I don't expect that one really should outweigh another, but this is the way I do it. I want to know each individual stock and their yield. You take the next 4 quarters, add those up, divide it over current price, that gives you yield. All 500, we dropped below the 5% yield level. What was it, going into the week before, early last week, dropped sub 5%, and I don't see a whole lot of downside there. Here's the key though. The S&P 500 is, broadly speaking, all 500 stocks represent the United States economy pretty nicely, but it also represents a lot of these companies are international. The 10-year Treasury yield is your benchmark investment rate. It's just above 4%. So when you look at the S&P 500, broadly speaking, there's still a lot of value left in there. Now I used the Spider ETF sectors, select sector ETFs. So you'll see XLK stock, that's the technology sector ETF. Again, one share in each of those. Add those up. Technology, we could easily see sub 3%. To me, broadly speaking, overpriced. But there are still some gems in there. You just got to kind of pick through them. So this gives you a snapshot of where that is. The most key indicator to me is personal incomes. There's 3 major sections to our economy: consumers, businesses, and governments. Now, governments will spend money and they keep things fairly trendline, except for the occasional stimulus package, which happens like every 10 years or so. And we did get a stimulus package at the same time that sort of COVID hit. That has helped to buoy the stock market. Now keep in mind that stimulus package, that was expenditures outside of the norm. Because of that has pushed the economy forward, keeping it sort of from falling. We've just seen an enormous amount of interest rate hikes that did not produce the recession we thought would happen. This particular indicator, if it continues a little bit higher, that's so key to me. Because if you follow the rate of growth of personal incomes from consumers, as the rate of growth either increases or decreases, so does the rate of consumption. We are more than 70% driven by the economy, by consumers. So as we're seeing this start to pop back upward, can we get up to, say, 3.75%? Here's the effect of personal incomes. If you overlay the two charts, you can see that as the rate of growth of incomes increases, so does the rate of growth of expenditures. Where do businesses get their revenues? Consumption. Whether that consumption be from the government or, which is over 70%, consumers. So if you want to know what's going to happen next in the stock market, straight towards personal incomes, this is a big indicator of that. But not necessarily, it's not 100%, of course. With personal expenditures moving higher, businesses are not going to be laying off as much. Why would they? They're seeing expenditures at their stores. The interest rate increases have not slammed the brakes on the economy as expected. Of course, inflation is another key thing. Here, I wanted to look at retail sales. We got this about 2 weeks ago. As you can see, there's two here, the green and the blue line. They're retail sales, and then retail sales ex autos and gasoline. Tends to be a little more volatile, but they're pretty much in correlation with each other. And as you can see, we've dipped a little bit and we're starting to head higher. Consumers are hitting the retail stores, whether that be Amazon.com or the Gap or whatever it may be. We're starting to see that little pop higher. We're not seeing unemployment numbers moving higher. Personal income versus retail sales. This kind of reiterates that there's a correlation between personal incomes and expenditures, but keep in mind retail sales is at a retail store or an online store. So you can see that there is some kind of correlation. There's a breakdown from total expenditures to just individual retail sales, but we are seeing those incomes moving higher. We will probably see retail sales moving higher. Gross domestic product versus, of course, personal incomes. As you can see again, the personal incomes are in blue, gross domestic product is in orange. As incomes move up or down, so does GDP. So we're seeing GDP, which came in blistering again, although not quite as much as everybody had expected. What this tells me is if we continue to see personal incomes moving higher and higher, guess what happens to GDP? Moving along, expenditures, personal expenditures versus inflation. PCE deflator, personal consumption expenditures deflator, or index, however you want to term it. The deflator, basically they look at the total prices and then they kind of adjust for inflation prices. The core PCE on this one is the blue chart, and as you can see, as incomes or expenditures move up or down, you can see that there's movement in overall inflation numbers. We're seeing incomes moving higher. We should see inflation continue to mellow out. But hitting that 2% number, where we are with interest rates, I see no reason whatsoever for the Federal Reserve to be lowering interest rates at this time. Employment or unemployment. This is unemployment insurance. Initial claims saw a little pop up from the previous week, but that could have been sort of a holiday related thing. Nonetheless, these numbers are incredibly low overall within the economy. Here is continuing claims, those that have not only started their claims from the week prior, but continue to be on those claims. Overall, broadly speaking, sure, this chart's a little bit high, but it is massively low when you look at it from a historical perspective. We're not seeing any kind of real unemployment occur. Non-farm payrolls coming out this Friday. This one kind of scares me. So the Federal Reserve itself is trying to shrink its balance sheet, which would shrink the money supply. This is M2 money supply. And as you can see, starting to pop back upward again. That means there's economic activity. So any slowdown that we saw, you can see how the money supply slowed down. I think that's done. We'll see how things move forward, but the Federal Reserve basically has the ammunition to say, we can continue to shrink our balance sheet to get to a more trendline rate of growth. One of the variables for doing that, interest rates higher for longer. The U.S. 10-year Treasury yield. My take on this is real simple. The Federal Reserve has no ammunition that the economy itself is slowing down at a rate that they should be sitting there saying, we need to hurry up and lower interest rates. The economy is moving forward just nicely. Now, they may need 2 or 3 more months' data to really solidify that. They have kind of indicated at the last meeting that there were some pencil marks on the trim of their most recent meeting. That doesn't necessarily mean that they are going to act on that. They aren't necessarily planning that right now. They were pencil marks on the edges, taking notes, whatever it might be. Nonetheless, when you look at the state of the economy, the consumer is moving forward. This level of interest rates appears to be neither restrictive nor accommodative. If you remove some of the restriction, then this economy would really accelerate quickly, which could accelerate inflation. Incomes are moving higher, so are expenditures. We're seeing the reports over and over and over again. If you lower interest rates, expenditures would accelerate. Given that scenario, that could easily ignite inflation further. I actually think that the Federal Reserve has room to kind of bump the inflation or the interest rate numbers up slightly, given the information we have right now. Maybe they sit around and wait 2 or 3 more months to kind of get more economic data. We did have the holiday season, so that could sway things somewhat. But for right now, unemployment numbers continue to be moving lower and lower. Employment is robust. Expenditures are robust. The interest rate levels at this point are neither too restrictive nor too accommodative. That I don't think that the Federal Reserve has any information right now that they can justify moving interest rates at this time. So Wednesday's meeting, probably my thinking, they stand pat, of course, and probably give us some kind of indication that they don't really see anything sort of pushing them one way or another, that the economy is strong enough. China could be a huge X factor. And the thing is, from everything I read on China, they're going to repeat what happened in Japan. In 1989, if you look at your charts going backwards a bit there, Japan had a massive recession that they still have not recovered from. If you look at the Nikkei, it has not gotten anywhere close to the peaks from what we saw back in Japan back in 1989. I expect China will probably repeat Japan. We'll see how that extra factor plays in. Europe, teetering. We could pull them out of a recession somewhat. We'll see how that plays out as well. But looking at the stock market itself, personally, I do not see any reason for it to go up or down unless, say, we get a very robust number on Friday, given the unemployment non-farm payrolls number we will be getting on Friday. This one here, there are stocks that are still undervalued. There are certainly stocks that are overpriced. You may get individuals stepping in and buying on those dips. And that could continue to propel things. If the economy continues to move forward at its current pace, there's no reason for the stock market to continue to move upward. I don't think we've gotten into an overheated area at this time. It's getting interesting. But nonetheless, this is something that, looking at it long term, we still don't have enough information as to how this economy turns. Will we see personal incomes really shooting higher? That would force the Fed to maybe raise interest rates because inflation would move upward. Still a lot of time left on this. I don't expect the Federal Reserve makes any kind of moves before, say, June 1st, because we don't have that information. Nonetheless, make sure to hit that like and follow button. I'll keep you guys up to date as to what I think will be happening with the economy and how that will push the Federal Reserve and the stock market. See you in the next video.